All right, today is Tuesday, September 29th, and this is a post-market review for the stock market activities today. Today's agenda, per usual, but we do have an important coverage in the options market review. I understand that some viewers are not very experienced with options, so we will revisit how options work, and after about 3 minutes of explanation, your understanding of how the market works will change forever. So stay tuned for that one. We also have some interesting headlines regarding the state of the economy and the unemployment. Of course, we do have an unemployment or jobs report on Friday, which will be very important. And of course, we do have charts for the SPY, the Qs, the VIX, the dollar index, Tesla, and here is a new one, Draft Kings. And here we go, the Dow Industrial Average in the red, 131.40 points or a decline of 0.48%. The Nasdaq in the red, 32.28 points or 0.29%. The S&P 500 in the red, 16.13 points or a decline of 0.48%. Here is the thing about today. We were expecting a rally, a build-up to yesterday's move, and the market conditions were paved for stocks to rally. The dollar index was down. Fed speakers were very dovish today. The call buying in the options market was still going on, yet the market stayed very muted to negative. However, we will not make a federal case out of it because the volume was very low, as you can see from the blue meter next to the charts, and this is perhaps in anticipation of tonight's debate. Traders are not making big moves until they hear the debate, so we'll give the market the benefit of the doubt. However, the action today, when you have all the conditions aligned for you to rally and you don't, this is very negative. And the longer the market takes to rally, the likelihood of a reversal increases significantly. If we don't see a rally after the debate tomorrow, that would be very bad signal for the market, and watch out for the reversal. We will of course brush over the debate in the conclusion of this video. But for now, checking on the sector's performance. We're not giving any medals today because the sector's performance was pathetic across the board. Healthcare, utilities barely in the green, tech coming out at third place. And leading the laggards of the market, look at this, energy, financials, and industrials. And we talked about this yesterday, whether the bounce in financials and energy is a dead cat bounce or the start of something. And I lean toward a dead cat bounce. And you see energy giving up all the gains today, even though the dollar declined today. Very bad picture for the energy sector. Moving on to the futures market performance. The gainers of the day, OJ, lumber, and sugar acting sweet today. Metals across the board, but specifically platinum and palladium. What's going on with meats? You see cattle rallying today while lean hogs in the red. And as far as grains, of course, oats rallying today, soybean oil giving up some of the gains from yesterday, the reverse picture of yesterday. And of course, we see crude declining today. Crude oil, every hint or smell of positivity gets crushed right away, and crude reverses back to the southern destination. Coffee muted today. We're waiting for an entry signal in coffee. With that being said, moving on to the big casino, the options market, the gamblers market, let's check out on how the tables did today. Not as hot as yesterday, however, there are new names, new tables entering the trade today. Before we dip into that, let me explain to you how call and put options trading works. Let's talk about calls, for example. When you buy a call, as you get closer to expiration date, either your strike price in the money or out of the money. If it is out of the money, meaning that the stock did not move all the way to your strike price, you have two options, either letting the option or the contract expire worthless, or you sell it for whatever time value left in the contract. However, if the stock moves as you expect and your contract is now in the money, meaning that the stock price is higher than your strike price and you're nearing expiration. You got two options. Number one, you sell it and you capture the intrinsic value plus the time value of the option. Or you can let it ride all the way to expiration and then you exercise your option. And in this case, you will own shares of the underlying stock at the strike price. Say you buy one contract for stock X at the strike price of 100. By expiration, the stock moves all the way to 110. Now you got the option to exercise your option and now you can own 100 shares of stock X at 100. And of course you would do that because you think that the stock will ride higher from this point on. It will go from 110 to 120, 130. And you want to hold the stock as an investment. Now let's look at the other side of the aisle, the seller's side. When you buy a call, somebody has to sell that call for you. Let's say we're nearing or closing to expiration date. If the option, the call option, is out of the money, meaning the stock declined and is nowhere near the strike price, the seller of the call will retain full credit. That is the goal when you sell call options. However, if the stock is nearing or in the money already, the option seller has two choices. Number one, buy back the option at a loss because the option will be now worth more than what they sold it for. Option number two, if expiration date is passed, the option will be exercised, meaning that now the option seller has to deliver actual shares of the underlying stock to the call buyer. Using the same example, Company X, the seller sold one contract at the $100 strike price of Company X. We're now at expiration, past expiration, and the stock is trading at 110. The seller now has to deliver shares and sell it at 100, the strike price. So they will have to go into the open market, buy the shares. In this case, it's a one contract, has 100 options, so they will have to buy 100 shares of Company X at $110 because this is where the stock is trading right now. And then they have to sell it at a loss for the strike price of 100. Now, with this explanation out of the way, you can understand why option sellers, the moment they sell you the call option, they have to buy the underlying stock. This is the hedge, because if the stock moves higher, they couldn't care less. They've already collected the money from selling the call option, and now if they have to deliver the shares at the strike price, guess what? They bought it cheaper, they bought it lower, and now they're just gonna sell it at a profit. No big deal. This is the hedge. Now, when you see a stampede, a Naruto-style stampede, when the Robin Hoodiots and the rest buy call options for any company, say Apple, call options riders have to buy stocks of Apple as a hedge. And what happens is, as you near expiration, not all of these option contracts will be exercised. Some of them will expire worthless, some of them will be closed before expiration, leaving option riders with an excess amount of shares that they don't need. And at this point now, they're making profit. They bought the stock lower and the stock now moves higher. So they have every incentive to dump the shares and cash in their profits. In the short term, a move like this causes a gamma squeeze. When you see the stampede, and that of course equals a rush to buy from option sellers, you see shares, in this case Apple, rallying significantly. We saw that in the later part of August, the famous gamma squeeze. And of course, some lazy option riders, they forget to hedge. And as we near expiration and the stock is nearing the strike price, they scramble and they try to buy the stock so they can sell it at a profit when it reaches the strike price, causing an intensifying effect to the gamma squeeze. Now you fast forward to where we are in September, and option riders have plenty of shares of Apple, excess shares, so they can ride more Apple calls, and now they need not to hedge and buy Apple stock. And what do you see is a pump and dump. They sell you the option, the 115 or the 120 call in Apple earlier in the week. The stock rallies for a day or two, and by the end of the week, they dump those shares, making the 120, the 115, the 110, whatever it is, expiring worthless. Now, what happens when you see a Naruto-style stampede buying calls in a new name, a name that is not widely held? In this case, today we saw Neo, we saw Boeing a few days ago, we saw Beyond Meat today. Now you see a gamma squeeze because option sellers don't own excess shares of the underlying stock, in this case Beyond Meat, Neo, Peloton, etc. So I hope that you now understand why Apple, for example, didn't move higher today while Peloton and Beyond Meat did. Of course, the media is not going to explain that to you. They're just going to say, oh, it's a piece of news. I heard them very confused today about Beyond Meat. And of course, they attributed the move to the collaboration with Walmart. And then the lady anchor says, okay, but we knew about the news of the collaboration between Beyond Meat and Walmart. But of course, they never talk about the gambling in the options market, which is responsible for the move you saw today in Beyond Meat. Now, the last point I want to brush on, and I hope I'm not making this too long or longer than I need to, but I thought it was important to explain. Now, what do you think about a market that is solely driven by options trading and options gambling, where option traders are buying calls, forcing stocks to rally, but they are bounded by short-term mentality, meaning that they're in it for the short term to cash in quick buck and move on. Likewise, the sellers are selling the calls, buying the stocks with the mindset of short-term profits, where they're willing to let the stock drive higher, and before it reaches strike price and expiration, they sell and they dump and they cash in their profits. Is this really a market that you want to invest in? Is this really a market that gives you any confidence when the participants are gambling and fighting each other over short-term profits, creating pumps and dumps all over the place? No thanks. And here we go. Let's go back to covering the casino. Apple at number 1, 1 million options contracts traded today. Approximately 63.5% of those were calls. At number 2, Neo, 800,000 option contracts traded today. 84% of those were calls. Do you understand now why Neo rallied today? Here we go. Tesla number 3, 700,000 option contracts traded today. About 57% of those were calls. And now moving on to the open interest, the change in open interest. Let's see if we can find some trades and some clues of where the market is heading next. Right away, you see the Apple 110 and 112.5 calls being closed. These calls expiring this week, and you see traders taking profits off the table. Likewise, another trade that caught my eye in DraftKings, the 55 call expiring this week, being closed, traders taking profits, assuming that DraftKings will trend lower. And by the way, today I bought puts on DraftKings. Now let's look at the volume leaders today, and as you can see, Apple 115 call still selling hot, and of course you see the contrast. Disciplined traders who bought the 110 and 112.5 calls are selling, closing, taking their profits, while the risk traders, the gamblers, are betting more on the 115 call. We'll see who gets the edge here by the end of the week, but I do have a hint that disciplined traders will be rewarded. Also, another interesting trade with a lot of volume is the DraftKings 55 put. Now you understand why I'm betting against DraftKings. And now moving on to the headlines that shaped the day. And the first headline, we will start with a segment called Fake News. Today, of course, we got the Consumer Confidence Index, and it has risen the most since 2003. Apparently, consumers are very, very confident in this very uncertain environment. I think we all know how this number was cooked right ahead of a presidential debate.
Well, got three kinds of meat in the meatballs. You've got veal, beef, and pork.
Ah, good, but you gotta have the pork.
Oh, that's the flavor.
I felt he used too many onions, but it was still a very good sauce. Don't put too many onions in the sauce.
And by the way, speaking about the consumer confidence and the good news in the economy, we do have breaking news after the bell. Disney is announcing laying off over 28,000 employees. Massive number for one company. And continuing on the theme of good news and the consumer confidence at all times high, or the highest since 2003, here we go. 40% of New York region businesses will declare bankruptcy. So far, 6,000 businesses gone in the New York region. We also have a report about the bankruptcies among small and medium businesses surging again. No worry for now for big businesses because they have the sugar daddy, the Federal Reserve, behind them, loaning them billions, trillions, doesn't matter, of interest-free money. Meanwhile, Main Street, small and medium businesses get nothing from the Fed. The Fed spent only 1% of their so-called Main Street lending program. You think the Fed is working on your side or the side of big business? And here are the specifics. You see the surge in the third quarter in bankruptcies. It is the highest surge so far. Meanwhile, we do have this Bullard personality in the Fed, this drunk high Bullard, saying that quarter three, the third quarter, will be the biggest increase in GDP ever. Try to explain that when you have bankruptcies surging across the country. And of course, we're going back to summer peaks with over 622 bankruptcies declared this month alone. Furthermore, we do have the distressed debt issuers increasing and spiking up again. You thought that the Fed and the government got that under control and we're not going to have distressed debt issuers in the junk bond market. However, you see the list right in front of you, American Airlines leading the pack. Very, very risky company to invest in. It is very possible without bailouts that American Airlines will fail and will have to be absorbed by a bigger operator. And now let's talk about JP Morgan, the laundromat. Because, of course, their boss, Jamie Dimon, the sweetheart of Wall Street, got caught washing money for mobsters and oligarchs and drug cartels. But that's just the half of it, because we've learned now that JP Morgan was running a scam in their trading desk, manipulating bonds, prices, and the gold and silver commodities market. And of course, they got fined today about $1 billion for the crimes they've committed. And indeed, there are crimes, and this is an article from Bloomberg that I recommend that you read, where the government calling the trading desk of JP Morgan a crime ring. So now we do have SoftBank manipulating the NASDAQ. We do have JP Morgan manipulating the gold and silver market. Do we have any clean market left to invest in? Of course not, because the Fed is manipulating the rest of the market. And by the way, speaking of the crime ring, here they are, JP Morgan increasing their S&P year-end target by 10%, and the number they gave us is 3,750. And the last bit of news, of course, we heard from a lot of Fed speakers last week and this week, and we do have the Cleveland president, and she insists that we really need fiscal support. Fed personalities, with exception to Bullard, of course, been begging the government for fiscal support, almost signaling that the Fed is out of ammo. And Mr. here says that the unemployment rate will be between 7 to 8% by year end. No worries for Jim Bullard of St. Louis, of course, because he expects the full recovery by year end. I guess if we all smoke a little bit of hash, the economy will recover on its own. But Mr. here says, perhaps this is the most important statement, that it is too soon to predict whether the Fed needs another asset purchasing program. And there you go. If you're just saying buy stocks because of the Fed is telling you we're done enough. For now, we've done enough. It is on the lap of the government to do fiscal support. But wink wink, we're out of ammo right now. Moving on to the heat map analysis. And as you can see, very muted day, leaning red. However, you see that the names that managed to rally are 100% tied to the action in the options market. If you got a name that saw a surge in call buying today, that name managed to rally. We're talking about Nvidia, Square, Shopify, Peloton, PayPal. All of these names had almost 70% of their option volume today as calls. And of course, we saw a surge in the overall volume in Nvidia and Square, Peloton certainly, and that is responsible for why these names managed to close in the green while the rest of the market struggled. This is why I know I spent a lot of time during the discussion of the options market, but it is important for you to understand. Without understanding that, you'll be very confused looking at the heat map. Why did this name rally? Why did this name lag? Now you know. And of course, we do have gold at the bottom right corner of the screen. You see gold rallying due, of course, the decline of the dollar index today. And moving on to the rotation trade, we see weakness across the board, but very notable the action and the contrast between Zoom and Peloton. Zoom closing in the red, Peloton in the green. These names used to trade hand in hand. What's going on here? Back to the options market. Zoom had a surge of options volume last week, the last couple of weeks, matter of fact, meaning that option sellers have accumulated lots of excess shares and they're ready to dump them and take their profits. Peloton, different story. We saw a little bit of a surge last week, but this week we're seeing a significant surge where you see Peloton closing among the top 10 option volume leaders. And of course, because option sellers don't have excess shares of Peloton, they're scrambling and they're buying shares of Peloton as a hedge for the calls they're writing. It is a matter of time before they accumulate enough shares and they dump Peloton too. The morons in CNBC and television, they're saying, oh, it's just moving as the number of cycles I did. I did 100 cycles. The stock is 100. Very scientific explanation. And of course, you see the struggle in the reopening names. Every time we hear about COVID, these names give back and decline. However, it's a tug of war between COVID headlines and vaccine headlines. And what do you know? After the market, we heard from Regeneron saying that their study is successful and it managed to reduce the risk of blah, 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 blah. And that's all what these names need to hear to rally again. Furthermore, we do have a debate today. A new bet that President Trump is going to brag about the vaccine and about the vaccine being announced and released very soon. And all of that talk will be very positive for the reopening stocks. Moving on to the charts analysis, starting with the SPY. Here is a 15-minute chart. Nothing happened today. Very flat, very boring day. You have the levels that you need to watch for. The support is at the gap, the former resistance, and that is at about 330.68 level. And you do have your resistance, of course, that we've identified in previous videos at 337.50, around that area. When we switch to a daily view, I want you to pay attention to the bullish scenario. We saw the formation that we're seeing right now after a decline back in May, where we saw a gap higher and then consolidation, building a bull flag before rallying later on. So is this what the SPY is doing right now? Consolidating, building a bull flag before blasting higher? Could be. It's certainly on the table. You have to be open-minded. But of course, there remains a negative mark of why didn't the market, specifically the SPY, rally today and marching higher. We need to dig for more charts or more information to have a clearer picture. And for that, let's move to the Qs. 15 minutes chart. As you can see, a similar look to the SPY, and we do have support at the 274.40 level. And as we discussed yesterday, the resistance is the trend line, the former trend line. From a daily perspective, again, the look is very similar to the SPY. It's the same discussion. Either we're building a bull flag to blast higher, or we're showing weakness and we are ready to reverse. Remember, we talked about a reversal, and perhaps the market is ready to reverse right after the debate. There is no more energy to push it higher. But we have to keep the bull flag scenario in the back of our heads in case the market decide to hear whatever positive news it wants to hear from the debate and blast higher. Moving on to the Dixie, and as you can see from the daily chart, The MACD of the dollar index been making this loop, this snake looping, making humps over and over, trending higher. And you can see I pointed those out for you in correlation with the chart. So if history is right, this is another hump higher, trending lower, taking a breather, and then resuming the trend higher, meaning more gains for the dollar index. And here is a 15 minutes chart of the dollar index. And as you can see, building on the discussion from yesterday, we do have the support, and the support was broken. This was supposed to be a very bullish signal for the market, but you did see the opposite. You saw dollar sensitive sectors actually closing in the red, and you saw the market overall struggling to climb higher. So is this a lag, a delay due to the debate, and we will see stocks rallying on Wednesday perhaps? Or is the dollar creating a trick and trap here where it breaks support, and what do you know, tomorrow it climbs higher again? If you are bullish in the market, you're saying the dollar broke support, the chart of the Qs and the SPY are doing a bull flag, and we will blast higher in no time. If you are a bear, you're saying, why didn't the market rally today when the dollar index gave the market the green signal? And of course, you're anticipating a reversal in the market and a blast higher for the dollar index after taking a break. This is the tug of war. Moving on to the VIX, and let's see what the VIX can tell us. Nothing. The VIX barely closing in the green, very muted. However, sometimes you need to switch to a line chart instead of a candle one. Sometimes it'll show you things that you can't see otherwise. And what I see from the line chart is a cup and handle formation, which is in general consensus among technical analysts is a bullish signal, indicating that the VIX will experience a rally very soon. Moving on to the chart of gold, and as you can see, gold rallying today due to the decline of the US dollar. I'm not buying the rise in gold. I see further decline as the dollar reverses course and starts rallying again. The resistance I see for gold is 1925. Certainly gold can rally all the way there, experience some resistance, pulling back all the way to the nearest resistance of 1860. It would be a big move. However, if the dollar continues to rally, it is very possible. So I'm not buying gold right now until the dollar is finished with its move. And we do have a confirmation that the dollar will continue to trend lower. As of now, we don't have any confirmation. And moving on to Tesla's chart, as you can see, respecting the wedge again, reaching the upper limit of the wedge, struggling to break through it. The more you struggle to break through it, the likelihood that you're going to reverse and visit the lower limit of the wedge. And therefore, of course, I opened some put contracts today on Tesla, expecting a decline from this point on. And now let's cover the new chart of DraftKings. We haven't covered this one before. As you can see from a daily chart, we do have the reverse hammer. This is a bearish signal indicating a reversal, at least in the short term. When you combine this information with the information we extracted from the options market, you can come to a rational and reasonable conclusion that DraftKings will trend lower, at least in the short term. And now let's conclude the video. We do have an important debate, a presidential debate today between Trump and Biden. And of course, absent of one of those guys having a stroke on stage or tanning themselves to death, there should be no surprises here, and we should hear discussions about the economy and the market. And of course, we're looking for the discussion about China. This will be a very meaty subject in the debate. Trump will accuse Biden of being in China's pockets. Biden would do the same. And they will compete, of course, on who's tougher on China. That could, of course, have implications in the tech sector, specifically semiconductor names. Furthermore, we will have discussions about the vaccine. Trump will likely hint at an announcement of the vaccine coming soon. Of course, I don't think Biden will oppose that. He might question the validity of the vaccine or the rush toward announcing the vaccine. But all in all, this would be good news for vaccine-sensitive names. The problem here, of course, is to the pharmaceutical and healthcare names. Both men will compete on who's tougher against the drug companies and who would make healthcare more accessible and cheaper to the population. Trump, of course, been accusing Biden of being supported by drug companies. We know Trump is taking on drug companies. He wants to lower drug prices. Biden also has a plan for that. So they will compete, they will accuse each other back and forth. But at the end of the day, there will be consensus. The drug prices must be lowered and health insurance must be more accessible and cheaper to the population. Both are not good news for these two sectors, big pharma and big health insurance companies. And of course, what about tech? We know Biden attacked Facebook today. Trump been complaining about Google and Facebook and all the other social media names. Both candidates are likely to be tough against big tech names, accusing him of monopoly. The Democrats, of course, love to hit Facebook. The Republicans love to hit Google. And that could add pressure on tech names, anticipating of regulations regardless of which party wins control. And of course, the last sector here is energy. And believe it or not, Biden is better for the energy sector than Trump. Of course, the consensus here is Biden and the Democrat with their greenhouse deal or green deal or whatever the hell it is will be bad for oil names or for energy stocks. However, the problem in oil names and the oil market is the excess of supply. And the Trump administration, of course, added supply on steroids to the market, removing regulations for drilling, and you saw a boom in oil production in the United States, leading to excess supply in the market and pressure on oil prices, and you saw oil stocks and energy stocks suffering for years now. They had the worst performance ever under President Trump. So while Biden might on paper look as anti-energy or anti-oil stocks, in fact, if he does what he wants to do and what the Democrats, specifically the progressive wing of the party, wants to do, all what that's going to do is shrinking the supply of oil. Thus, the price of oil will increase and energy stocks will recover. So it's very important to see how energy stocks will react tomorrow after the debate. And the last bit here, of course, assume that President Trump will brag left and right at any opportunity he can about the stock market. And we know that every time he brags about the stock market, it marks a market top and the market sells off right away. So lots of bragging today. Don't be surprised if the market reverses tomorrow.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.